Hi, good morning. Welcome to the latest in our series of webinars from the Saïd Business School, University of Oxford. And today we are looking at private equity. So this is in support of our executive education program in private equity, the Oxford Private Equity Program in June, which is directed by Professor Tim Jenkinson, who we have with us today. Tim will be in conversation with Chris Callos, who is a partner with Kirkland and Ellis, a corporate law firm from the US, but in their head office in London, in the city, in the Gherkin today. So a pleasure to be here. Thank you for having us, Chris, and thank you for giving us your time this morning. So the format today will be really a discussion and conversation between Chris Callos and Tim Jenkinson around a number of topics which are live and developing in private equity at the moment, and what's happening on the private equity landscape. We have some notes and topics which we will talk through. We've got more than enough to talk about to keep us going for about 40 minutes or so, but we would love to have your questions as well. So as we go through, if you can enter any questions, there will be a question panel or doc which you can see. So please type in any questions there. And we will try to address some of those towards the end as well. So we'll aim for about 40 minutes from now, and to take your questions from about 25-30 minutes in or so. So thank you very much. We have a good number of registrations for today. And it's good to see that we have a good number live as well. So I don't know where everybody is that's online at the moment. We've tried to experiment a little bit with the time of this to get the Europe market. For those people listening on record and listening back, welcome, and thank you for logging in from wherever you are. So this webinar is really to share some of the research and thoughts and topics that are being talked about at the Private Equity Institute at the Saïd Business School, but also to help raise awareness and promote our executive program in private equity as well, which is in June. I'll give a little plug to that at the end, but just to say that that program is starting to fill up now. So if you are interested, then please contact us, and we'll talk to you about that and sign you up as appropriate. So without further ado, I'll hand over to Tim Jenkinson to briefly introduce Chris and to roll on to the conversation. Thank you, Tim.
Great, thanks, Steve. And Chris, thanks very much for hosting us again. This has become an annual event, so and good to always get an update on where the market is. And at the conferences I go to, everybody's talking about the sort of heat of the market, how hot it is. There's a lot of fundraising going on, a lot of big funds being created again, and people seeming to be able to raise money very rapidly. As one of the leaders in fund formation, Kirkland must be at the sort of leading edge of that, because you get to form a lot of the funds which are coming to the market. So what's your take on the state of the market? Are we back in 2007? Are we beyond that? Should it be worrying to LPs? What's your take on that?
Sure, it's a robust market. It doesn't quite feel as frothy as prior markets where you started scratching your head about how long is this going to go for. So it's not kind of on fire, but it is robust. And for managers with good track records, they tend to be raising fund sizes a little more slowly than they did last time this happened, maybe 10 years ago. And so existing LPs are really worried about getting their allocations, the allocations they want in these funds. And as I said, existing LPs, right. New LPs are having a hard time getting into a lot of these funds. We're seeing one and done closings. Sometimes fundraisers can take a year or more. We're seeing fundraisers have one closing. You need to be in at that closing, or you can't get in, or you have to at least have committed at that closing, and there might be a cleanup closing a little bit later. There's a lot of dry powder still, which is always something people keep an eye on. I saw it listed as 2 trillion, which interestingly is only supposed to fund 3 years of investments, when in 2007, which you referenced, there was about 1 trillion of dry powder, and that was expected to fund 4 years of investment. Yeah. So there's more money getting put out there into investments as well. And I think also helping the market is that for the 5th year in a row, the funds have returned more money to investors than they've called from investors. And so that's helping investors allocation in the aggregate, allocation opportunity get larger. And so that's also driving the market. Economics are still kind of 2 and 20 with an 8% disappearing preferred return hurdle. So it hasn't really resulted in a dramatic change in the economics, although we are seeing premium carry in exceptional cases, usually for hitting a high multiple of money.
Yeah. And so it sounds like almost like a classic definition of a seller's market in a way at the moment, that
Yes.
that the funds are able to dictate the terms. Is it bifurcating at all into the ones with good reputations, been around for a while, rather than the early stage LPs, the early stage GPs? I mean, are we seeing a lot of new GPs being created, or is it really consolidation of the big brands who've got established track records?
To some extent, both. It's a bifurcated market in that people who have great track records or who otherwise have a great story are able to raise, everything they're looking to raise, and to do so relatively quickly. People who have a more challenging story have a more challenging time, and it may be that they can't hit their targets even with 2 years of fundraising. In terms of new managers, I think we're at a point in the market where succession fallout, if you will, has resulted in lots of new managers coming to market that have actually good track records, and are able to raise money. So there's a first-time manager situation where you have 3 people who've never worked together before decide they want to get into the fund business, coming out of some related business. That's really hard. But when you've got groups that are sort of either spinning out as a group, with or without the kind of blessing of the original home for those folks, that can be a really good story, and we're seeing a lot of that stuff.
Right. And in terms of the economics, I mean, we always expect that, in a way, when it's a seller's market, you expect that maybe the terms don't get any better for the investors. But is there any, when we're seeing innovations there, is it that people are getting rid of the preferred return, the hurdle rates, or are they asking for premium carry, more than 20% of the profits? Or are we seeing much of that, or is it still the exception? And where you do see it, what does it tend to be?
I think most of the GP leverage right now is driven towards increasing their fund sizes modestly and getting a fundraise done quickly.
Right.
That's where they're, I would say that's where most
so
of it's
they're not
going.
sort of pushing the terms too much.
Some are pushing the terms on premium carry. I mean, that's the term that makes the most sense to push. LPs are more open if you get, outsized returns to give you a bit more of the profits. They're not all that interested in giving you more fees, so it's very hard to raise fees.
Yeah.
And the preferred return has basically been, very persistent. It's a disappearing preferred return hurdle, as you know, and so it looks a little odd for sponsors to try to push that lower, because it sort of signals a lack of confidence that they're going to deliver the returns that are expected.
Because the only reason why, so a hurdle only really kicks in a sense, if you don't perform very well, if you don't hit the hurdle, and to a fund saying, oh, well, we even want to make profit when we haven't made an 8% return is a bit of a weird signal, isn't it?
Yes, I mean, you would have to be returning basically less than 10% in order to have that matter. And nobody wants to be in a fund that's projecting return less than 10%, at least in the private buyout and growth equity space.
Yeah. And do you find that, because I know some of the funds have historically offered different types of management fee and carried interest arrangements. Do we see any of that? And
we're seeing some of that. That does happen from time to time. Some major sponsors have done that in the past. So it hasn't become a major trend in kind of commingled funds. It has become an interesting trend in co-investments, and I think we'll talk about co-investments later. But we are seeing kind of choices for how the economics get tweaked in a co-investment arrangement, and we're also seeing economics in co-investment arrangements, which is, I think, an increasing trend.
Yeah. One other thing I wanted to ask you about the sort of GP-LP relation side is I've seen that in the US, ILPA have been in discussions with the SEC about some of the fiduciary duty sort of rules and the like about for GPs. And I was wondering if you can just explain to us a bit what's going on here, because especially in Europe, we're a little bit further afield from that. But is this important? Is it significant, not just in the US, but in other countries as well, do you think?
Well, essentially, ILPA, I think, is trying to get the SEC to weigh in more heavily on their concerns. And so they wrote, I think this may be their third letter to the SEC about things that they would like to see some pressure from the SEC on, or some regulation from the SEC on. Both of the items that are in there are frankly a bit surprising to me. The first is sort of an allegation by these institutional limited partners, and it's signed by a whole bunch of leading institutions in the limited partner community. And one of the provisions, that one of the things they're seeking is some help from the SEC against this wave of fiduciary duty standards getting eroded,
right,
that they say is happening.
This is in the LPA, is it?
In the LPA, they have this sense that there is a big push by sponsors to disclaim fiduciary duties.
Right.
And I think that's just not factually right, at least in the private equity, growth equity kind of space. It may be going on in other types of alternative assets, but in the stuff that we're primarily focused on for this conversation, I'm not seeing it. There was a trend maybe a decade ago. Delaware Council, because these are typically Delaware funds in the U.S.
Right.
And there are fiduciary duties that the GP, as the managing partner, effectively has to the limited partners.
Yeah.
And there was a kind of push by Delaware Council, based on some cases that had come out, to get the sponsors, the GPs, to say some additional things about fiduciary duties that would have, put more limitations on LP rights. The Delaware Council basically said, if you want to say things like in the GP's sole discretion, and you want that to mean what in plain English it sounds like it means, you need to add a bunch of words. And the LPs didn't like those words, and that didn't last very long. So that was, there was about a year or two where that was kind of in flux, but the LPs sort of won that point. There are things in two kinds of fiduciary duties that are relevant here. One is your duty as the general partner of a Delaware partnership. The other is your duty as a registered investment advisor. So when that first wave happened, it was before everyone had registered, and there weren't these fiduciary duties that came out of the SEC. Now there are, and you can't disclaim those. And so there are these fiduciary duties that come from regulation, and there are fiduciary duties that come from partnership law. What does happen is there are some in the LPA, some limitations effectively on, or interpretations of what fiduciary duty means in specific contexts. So the duty to kind of offer opportunities to the partnership is typically modified in the LPA by saying these are the kinds of opportunities that do need to be offered to the partnership, and these are the ones that don't. So it's very upfront and obvious to people. And then in terms of a standard of care, it usually says if you want to be indemnified or exculpated, you have to have not committed gross negligence or willful malfeasance. And so that is in a sense a limitation in a way on it doesn't really limit your duties themselves, but it limits the consequences of your actions in certain contexts. So if you commit ordinary negligence in a typical Delaware fund, that's something that does not cause you to lose your exculpation and indemnification.
Right.
But again, that's very upfront in the fund document, and these are highly negotiated. Which kind of brings to the second point that's in the letter of the SEC, which is this desire to try to impose a negligence standard, effectively, or something closer to a negligence standard, there's ordinary negligence standard on the sponsors, and that seems, in my view, unlikely to get traction with the SEC, in part because the SEC also regulates public markets and big publicly held corporations where the investors have unlike private equity, have no opportunity to negotiate the terms under which the managers manage those corporations. In theory, they do. They got to have a stockholder, vote to try and change things. But the individual LP, or in that case, shareholder, doesn't have an opportunity to say, well, in buying these shares, let's negotiate what your articles of incorporation say.
Right.
In private equity, they do. And in the corporations, the SEC and all the investor communities, including the same investors that are in private equity, accept a negligence, indemnification for negligence. So it seems odd to me that that's what they focused on in this particular round of things with the SEC. So I don't think the first one really has a lot of sort of factual support, and the second one I think is sort of contrary to what the view that the SEC has taken in the public markets.
Right. Interesting. Well, we watch that space then, and it's not something that's really reared its head here in Europe, I think, very much. But we'll, as I say, maybe come back to that next year. couple of other things I wanted to touch on, some of which we've spoken about in the past, and we've spoken in the past about fund restructurings and what you do at the end of a 10-year life of a fund and things like that. And in the past, these used to be given the name of sort of zombie restructurings, or the living dead at the end of a portfolio of an investment, of a fund life. But I get the impression it's no longer really. We're no longer looking at a sort of just the funds which have been left with some things which aren't worth very much. But I see some people now, fund managers, who are sort of trying to bring the end of the fund, a bit more definitively, and these aren't necessarily bad funds. So could you just give us a bit of an update about sort of what's happening and how it happens, how they sort of manage to truncate the fund life, as it were, at a distinct point in time?
Sure. And one thing that's helpful is that we've changed the nomenclature to something that sounds much more friendly. All these things are now called, these and other related things are called liquidity solutions, which is what we're actually doing, is creating liquidity for people that are interested in liquidity. So when you get a fund that is late in its life, it may make sense to continue to hold those portfolio companies and to continue to work them and improve value, or it may just be a bad time to sell. And so rather than have the investors sort of be stuck in this fund with investments that are going to be maybe held into year 14, 15, or longer, some of these liquidity solutions exist. One is to just have the secondaries market, where there are funds that have been formed that go and buy LP interest, so the LPs can get out by selling their interest. There's also this concept of a fund restructuring, where the fund continues to exist. Perhaps it gets merged into something else, but it basically continues to exist with a coalition of the willing. So there are a bunch of perhaps new investors that will provide liquidity to the fund to kind of redeem out.
I see. So they're sort of sales of the existing stakes of the fund, are they?
They're effectively like selling the whole portfolio, although it usually is more tax efficient than that, so there's often not an actual sale. But the portfolio changes ownership, and there are, imagine effectively a new vehicle created that has the LPs that want to roll into that vehicle and continue to participate. It also has new investors who will provide capital to redeem or provide liquidity to the investors that don't want to participate. And in that arrangement, often the carry can be reset, the economic terms for the GP can be reset, and the fees. And so there may be a different go-forward economic arrangement, at least for the new investors. And so it can address lots of different things. And it no longer has this taint of hey, there must be something wrong with the manager. Very successful managers have lots of funds. Some of those funds are old, and this ends up being a good solution for some of those funds.
So two things that come to mind are, when those restructurings happen, presumably the GPs realize some of their carry at that stage on the value created to date, do they?
Yes, as for the LPs that are exiting, yes, they often would, where that wouldn't necessarily happen in an LP, above the fund sale to a secondary buyer. So if there is some carry that has not been distributed yet on the interest of the investors that are exiting, that will often be crystallized and often paid out. And so that is part of what GPs like about these. They also sometimes blend into, or are stapled, quote unquote, to a primary commitment to the GP's latest fund. So those investors that are coming in will often also commit to the GP's most recent fund. But GPs should go into these situations with their eyes wide open. Lots of these things start and don't finish. There are challenges to getting them done. They're complicated transactions, and there's exposure to there not being enough seller interest to match the buyer interest at the price the buyer's willing to pay. And that price can change if valuations in the portfolio change.
And presumably there are some specialist funds that have come into this market to be on the buy side of these deals, are they? And
some traditional secondary player, either the traditional secondary funds or specialized funds from lots of the traditional secondary players operate in this space, and some others, but that's one of the some ordinary investors will also participate, but there are some dedicated funds to this kind of opportunity.
I mean, I suppose whenever there's a sale of a private asset where you haven't got especially when the parties buying and selling are sort of have a heavy overlap, put it that way, they're not exactly the same thing, but presumably valuation becomes a big concern, does it? Because the selling the people leaving at that stage want to make sure they're getting full value.
Yes, and there's usually some kind of effective discount from value for the people getting liquidity, and that's the cost of turning an illiquid asset into a liquid asset. But yes, people spend a lot of time on valuations, and the GP works sometimes with the buyer to try and craft something that at least the GP thinks is a fair enough deal to take to the investors. They don't want to take to the investors something that they think is just a bad deal. But take to the existing limited partners. But ultimately, there have to be enough existing limited partners that want to sell at the price the buyer wants to offer. So there's also often not a direct negotiation there, but there can be some adjustments as the process moves forward.
Yeah, it always strikes me that over the years, private equity we always talked about private equity as a very illiquid asset class, and over the years it just seems to be getting more and more liquid. There's for those who really want out, LPs who really want out, there are all sorts of options now, I think.
Yes,
isn't that right?
That's right.
And so you always think that liquidity premium should gradually reduce, because actually it's not as illiquid as people want, alongside the idea that actually the many institutional investors need that much liquidity in their portfolio. So I think it's an interesting topic. Can we just change tack a little bit and look at another thing that I've been involved with a little bit, which is some of the discussions in the US about public pension plans, where alternative assets in general and private equity in particular have been a bit under the political spotlight of the politicians have been concerned about the size of the fees and seems like the carried interest payments that are being made by these funds. Really what your view is on that, and whether you think that's going to be a theme that continues and whether it's political or whether there's actually sort of real merit in what some of the arguments that are coming out there.
Sure, I think this is an area of real concern. The state plans, the U.S. state pension plans, are very large investors in private equity. They're very important partners to the sponsors, and they are trying to address a shortfall in these private equity in these private or public pension plans by investing in a high returning asset class. There has been this sort of political infection of this process, which has not been helped by a couple of, I think, mischaracterizations of the facts. And so what we're seeing in part is, and I also want to be careful here, because reasonable minds can differ on this, right, including reasonable minds at my favorite business school. We have a situation where investors all over the world are trying to get access to this asset class, and the folks with the most access to this asset class are really the U.S. state pension plans. They, on behalf of ordinary government workers, large swaths of middle-income workers are participants in these plans. They have access to this asset class on really great terms. So they're getting, because of their size, the best terms that anybody gets, and they're getting a better tax position because of the U.S. Constitution, frankly, than any investor in the world. Really? And so they're in a very good spot in these funds. And I think it's important that they continue to participate. And I think they will. I think the people running these plans, think that this is the right thing to do. But some politicians, for various political purposes, have sort of mischaracterized a few things. So one, they take the carried interest and they cast it as a fee, with the idea that if we could just get rid of the carried interest, we could save fees and look at how much we've paid in fees, including carried interest, which is a profit participation, over all these years, and gee, we would have $1 billion more in our plan if we didn't have to pay those fees. I think the problem with that is that the carried interest is a share of profits, and so the best performing funds are going to have the most profits, and they're going to have the highest fees, if you want to count a carried interest as a fee. The idea that you can save fees by getting rid of performance strikes me as a pretty flawed strategy. So let's get rid of the high performing asset classes so that we can save the share of the profits that we're giving to somebody else. Doesn't make any sense. Yeah. And so that's the first thing that I think is a bit off, and I think is causing the summaries of what's going on to people to be not right. The second factor that I think is going on here is that some of these pension plans just happen to be overweighted in low-performing funds. So you've done, I think, some great research that even the, correct me if I say this wrong, but even the median private equity fund, net of fees outperforms the public market.
Virtually every vintage year. That's true.
And so that's why people want to be in this asset class. And but if you happen to pick, for one reason or another, the underperforming funds, you can underperform. And somebody's going to be in the underperforming funds. I think there's one pension plan in particular that sort of made some strategy decisions in connection with its investment program that caused it to be adversely selected out of the best or the most sought after funds. And so, that pension plan, not surprisingly, has underperformed. But I think that's because of a flawed strategy. And so I think if you sort of look at carried interest as something you're happy to pay, as people in private equity do, as something that you're happy to pay because that means you're making money, outsized returns for yourself. And just look at the actual fees that are paid regardless of performance as the fee. I think you have a much fairer characterization. And the way to evaluate this, I think, is what is your performance net of fees? Look at the returns to the private equity funds, not what the manager has earned. Because what the manager's earned it's interesting politically, and it's a way to kind of play on some of the income inequality topics that are in the press all the time, but it really has nothing to do with what you're doing for your constituents. What you're doing for your constituents is what are you delivering on a net basis.
It all struck me because, as you know, I was involved in this debate, and whilst clearly both fees and carried interest come off the gross return that the fund earns. On the other hand, you can't really add the two together, I don't think, because it doesn't make sense to think about them in the same breath, because one you want to minimize and one you want to maximize.
Right.
You want to minimize management fees, but you want to maximize carry. And so therefore, if you go in there with an objective saying, we're going to add these two together and think of them as fees, and you say, then what do you want to do? Do you want to minimize it or maximize it? And the answer is, well, you can't really think of them in the same way, I think.
That's right.
And so it's an interest, but politically, it can be, it can be nice to lump them together and say there's an awful lot of money flowing to the GPs, which is true when they're successful, I suppose.
And I think when you look at what other non-US pension plans are doing in this space, it can be instructive. So what Canada has done, it is invested in really top flight management for their private funds, not just in investing in funds, but they're developing co-investment programs and direct investment programs, and those are actually reducing their fees that they are paid, the cost of doing this, because they're able to participate directly in investments at either reduced carry-in fees or perhaps no fees. Right. And so Canada's doing that successfully. Other sovereign wealth plans are also doing that, but that takes a real commitment. That means you have to hire really top flight investment folks,
and you have to pay them as well.
And that can be very hard to do in a government position.
Yeah,
because you've got pay scales, and how can this person be making more than that person? And so it is a challenge. But I think if you want to actually do better than what they're able to do now, which is pretty good, right? So that they, as I said, they've got the best economic terms and the best tax position. But if you want to try and improve on that, that's a very significant investment. And so they have to determine whether they want to do that or not.
Right. Yeah. In terms of a few other sort of areas, moving aside from the pension schemes, but what about family offices? Because I see many more of them, come along to the talks that I give and come on my courses, and they seem to be trying to find ways to navigate their way into private equity in a more sort of determined way now, I think. Seem very keen on co-investment, quite keen, some of them very keen on direct deals as well. What are you seeing as the sort of latest trends in the market with family offices?
Family offices have always been a natural fit for private equity. They've got a long-term time horizon, so they can be patient capital, and they, usually are flexible in how they allocate their portfolio. They have been playing, I think, a more important and significant role in the industry in a variety of ways recently. And people are taking notice. So we, for example, have formalized a family office practice at Kirkland & Ellis to better innovate around and deliver complete solutions to the bespoke needs of family offices. So among the things we're kind of seeing in the family office part of the space here are family offices developing sponsor-like structures. So they'll actually have kind of a mini GP arrangement inside the family office, and that can help them attract great management,
Right.
Reduce fees, save taxes, and we've got strategies for these things. And it also can help facilitate intergenerational wealth transfer and intergenerational knowledge transfer. And so that's one of the things that I think family offices are looking to get out of their programs. Private equity sponsors are also, some of them, building their kind of program around the family office or family business ecosystem. So there are some very well-known large managers that have done this successfully, and we're seeing a number of emerging managers and newer managers in the space. Some of those are folks who have operated family offices solely for the benefit of their own family and are now integrating in the management of other families' businesses, but they're also relying on those other families, many of whom were entrepreneurs and kind of created a major business that they maybe have partially exited. They're relying on those folks for sourcing opportunities, so they're getting some proprietary deal sourcing and also kind of advice on their investments. And so that's another sort of thing that's happening in the family office space that I think is really interesting. And then finally, the fact that they're offering this differentiated kind of patient capital, and they don't need to fit managers into a box like maybe a fund of funds might need to do, or they don't have any particular, they don't need to have any particular industry weightings or anything like that. It does make it easier for them to participate in things like long-dated funds, or these opportunities where some of these fund restructurings operate the way I described. Some of them operate a little differently, where you have one or two companies left in the fund, and you might, let's say it was one company, or maybe you have two left, and one you're planning to take public next year, and the other one you're trying to figure out what to do with, but it's a good candidate for a much longer term, maybe somewhat slower appreciating hold. You might just create a kind of single portfolio company fund-like partnership that's going to hold that investment for another 6, 7, 10 years. That's an interesting opportunity for a family office. And so particularly if you can drive down the carry-in fees a bit for that, and maybe it's projected to return 12% a year or something, and maybe 10% net of fees even, that can be a very attractive long-term hold for a family office. And so they're great candidates for some of these more longer hold strategies. And then for co-investments generally, they're also
and in terms of
participate.
Co-investments, I mean, we've talked about this in the past, maybe just a quick update. I get the impression there's no sign of that desire for co-investment waning. In fact, it just seems to grow all the time. Is that your impression as well?
It does grow all the time. I think, there's always been investors who want to know about co-investment opportunities, but don't necessarily have the capabilities yet to execute on those effectively and quickly. But I think a lot of them are thinking that they will during the term of the investment period for the fund, so over 5, 6 years, that they will have that capability. And so they're asking more about co-investments now. And co-investments continue to be a big deal in the market. So one of the things that they're doing is sort of displacing club deals. So if we were doing this 5 years ago, we would be talking about club deals where multiple sponsors are chasing an investment.
And they were sort of
together.
They sort of died a bit because the SEC, didn't they? Because the SEC started saying you were acting anti-competitively at the GP side to collaborate on these deals. So.
There was a little bit of that. There was also the fact that the fund sizes have gotten larger, and so many of these groups don't need to go partner together to buy a company, but take private. I mean, lots of companies are just staying private longer, and so those were really useful in trying to take a public company private. They're typically often less necessary in private companies because the companies maybe aren't so large. Also, so they are displacing the club deals a bit, and they're also kind of investors like the opportunity to sort of decide whether they want more exposure to a particular industry that might be part of the co-investment, or they think that perhaps they can outperform the commingled fund they're in if they actually were able to kind of pick their investments. And so that's one of the things that we're seeing the co-investment. So there's more and more of it, and more interest in it. And as you might expect, when there's more demand for it, something may happen on the other side of the market.
Yeah.
And so there's now, if we were talking 5 years ago, I think we would be saying that it's pretty rare for co-investments to have a fee or carry component. Now it's becoming pretty common. So we're seeing that a lot. It's often not 2 and 20, but sometimes it is. It might be, as we were talking about earlier, you might be giving investors a choice. And so you might say, okay, for existing investors that have committed to our funds over the years, we're willing to do 0% fee and maybe 15% carry or 20% carry. And if they prefer, they can pay some amount of management fee and have a lower carry.
Right.
And then they might also differentiate kind of new investors. Like if you haven't committed to our funds, maybe your terms are 2 and 20. Or something closer to 2 and 20. So they are getting investors. We are seeing people being offered choices on co-investment in terms of what the economic arrangements are.
Yeah. Now, we're obviously got about 10 minutes to go, and so I was just going to ask about quick update on credit funds, because whilst this is mainly about private equity, we see also, a lot of debt funds being raised, doing sort of similar things, a little bit different point of the capital structure, but those seem to be still going pretty strongly in the market. Is that your impression?
Yeah. So there were lots of new managers in the credit space over the last few years. I think the growth in new managers might be slowing down because it's lots of folks that wanted to get into credit products that maybe had other products have now done that. But there's still lots of scaling of the assets under management. This part of the asset class is an area where lots of separately managed accounts or other bespoke arrangements are being negotiated. And so while in growth equity and buyout, most funds are still primarily commingled funds. In the credit market, there's an opportunity to tailor the offering much more to the individual investors' needs, which often include very important tax considerations for say non-US investors.
Right. And in terms of the sort of looking further ahead, you get to see things maybe from Kirkland's perspective. You're seeing things which people are thinking about in the future and the like. Are there a couple of peeks into the future that you would give us that might come around? You're starting to see people think about it, but are possibles for the sort of development of the private equity space?
Sure. I would say probably 3 things come to mind quickly on that. One is that I believe we're going to see more large leading corporations, industry leading corporations, figure out how to make strategic investments into the private equity space.
So these are public companies you're thinking about?
I'm thinking about mainly public companies.
Yeah.
And if you remember years back, people were talking about corporate venture capital.
Yeah.
And I think that was a very interesting thing for a while, but I don't think they kind of solved all the issues that need to be addressed in the kind of corporate venture capital 1.0. Here, again, maybe we should have new nomenclature. So for now, we'll call it corporate strategic equity. But I think they've navigated those issues in a more helpful way for all the constituents. So they've addressed issues about prospective portfolio company concerns, about sharing of confidential information, et cetera. They've thought through what other kinds of investors might complement the strategic investor that's coming in and maybe anchoring a private equity fund. And so these things are happening both inside corporations, which was sort of what the corporate venture capital 1.0 was also doing, but it's also happening kind of outside, where they're spinning out teams, or they're finding a dedicated manager in a space that they think is strategic to the public company, and finding ways to partner with them. And so I think that's going to be an emerging trend. We've seen some of them already, and I think we're going to see more. In addition, I think there's a lot of pressures, maybe a little more technical, around advisory boards. And so the role of the advisory board is getting pulled in multiple directions. More investors want to be on the advisory board, but they then also want the advisory board to not be above a certain size because they want to have an outsized say. Sponsors are relying on them more as conflicts kind of necessarily come up when you've got multiple product lines and multiple funds and some of these fund restructurings. And so there's increasing dialogue with the advisory boards. At the same time, some of these advisory board members are hesitant to actually vote. So they may they like having the information, And there are some things that they do want to vote on, but there may be other things that they are deferring to or want to defer to the limited partners for. And so I think we're going to see some change to that. I think we'll see more advisory board observers, and I think we may see a change in the voting mechanics such that, you know, it'll be a majority of those voting that carry the day on a consent instead of a majority of the total. So, you know, a non-vote will no longer be a no vote. It won't be a yes vote either, but it'll no longer be a no vote. So I think that'll also change. And then I think we talked about one of the other things is sort of the single investment co-investments that we sort of talked about already, and I think that's going to be, you know, a major trend over the next couple of years.
Great. Well, thanks very much. Just a few questions have come in while we've been on air. Well, we've had quite a few questions, but I don't think we can take too many of them. But are you seeing? I mean, one that's come in is about the valuation of the funds in the secondary transactions and the like. Is there any particular, presumably? I mean, the question is whether there's a particular sort of metric that's used in valuing those funds or the existing remaining portfolio companies. Presumably, that's just they get specialized third-party consultants to come in and value these things. They don't do it themselves, I guess.
I mean, it depends on who the buyer is and what the facts and circumstances are. In a number of cases that I've been involved with, there has been another kind of valuation, either confirming or supporting transaction that might be happening at the same time. So maybe the portfolio company is doing a recapitalization itself, and you kind of do it around the time the portfolio company is doing a recapitalization. Or it may be in these unicorns, these large private companies, and then in stressing, one of the things that I think you've stressed in your research about why you want to be in private equity is because it's becoming a bigger part of the investable market as companies stay private longer. In these large unicorns, they will often have some internal transaction that gets liquidity for their employees. So a tender or something internally that will set a price, and then the price that the sponsor does their transaction on is often related to that price, either another round or some kind of liquidity option that's happening at the portfolio company.
Yeah, and a couple of other questions come in about any particular sectors or geographies you're seeing. I realize that you're mainly based in the US and deal with a lot of US GPs and LPs, but there are questions about are you seeing lots of funds specialized on oil and gas or in developing countries or things like that. I realize there's been some issues on it. Developing countries, probably a bit of a shadow of the Abrage effect, where which was probably not positive. But any thoughts on sort of sectors and geographies?
Sure. So while I'm in the US, I'm and representing mostly US funds, although some of those also have international operations. We have over 350 fund lawyers at Kirkland, and so they're in every kind of major financial center. Yeah. And so yes, we are seeing that. There's lots of activity in Asia, which is sort of I think a genuine uptick from what we've seen previously, and so that's exciting. I think people are looking at emerging markets a bit more. I think those are harder than even some of the kind of established economies in Asia that maybe weren't as in favor previously and now are getting hot. But we are seeing some of that. There are funds focused on various regions in Africa. There are funds focused on Eastern Europe. We definitely see a number of technology, more venture-y, typically technology companies focused on specific geographies, whether it be Israel or others. And as there have been historically, there are also a number of South American focused funds.
Yeah, good. Well, thanks very much, Chris. We're going to have to call it a day there, but thanks as always for your sort of update on the state of the market, and look forward to seeing you in June in Oxford when we'll be doing our regular private equity calls.
I'm looking forward to it as well.
Thanks. And now at this stage, I'll hand back to Steve.
Thank you, Tim. Thank you, Chris, both for your time this morning and for going through that. Thank you as well for those people who sent in questions. I'm sorry, I know we've not been able to attach many to attack many of those. We'll try to do a couple of those afterwards. So really to wrap up today, we are talking about some of the developments in the private equity market, really kind of promoting our executive program in private equity, which runs in June in Oxford, the 3rd to the 7th of June. So this is a 1-week, 5-day program where we have people from across the sector who join us. So we aim for 40 people in the classroom. Typically, they will come from 20 different countries and have, on average, about 20 years professional experience each. So these people come from LPs, from GPs, from banks, from corporate finance consultancies. We also have a significant number of people who are from corporates, so finance directors, strategy directors, corporates who are running internal funds or who are working in M&A. So looking at that over the week, we will look at private equity from the lens of the institutional investor. So how much does it make sense to allocate to private equity in your portfolio? Why? What are some of the limits around that? We then look from the perspective of fundraising. We look at how to select funds, how fund performance is measured. We go on to look a little bit at leverage, modeling. So just to kind of have a quick look through the timetable for this week, and I appreciate this is quite small, but we can send it on afterwards. We'll see that we are looking across the piece with a number of guest speakers. So Chris Callos, our speaker this morning, will be doing half a day on modeling the waterfall, fund governance and structuring. We will look at evidence on private equity performance. So how has private equity performed across time and in different sectors? Are large funds bigger than small funds? Are different regions more profitable? What are the rising trends? We have a talk from Patrick Healy, one of the founders of Hellman and Friedman, about private equity from the point of view from the GP. We will look at some case studies. We will have a session on Wednesday, really looking at what's it like to be working for a company that is managed by private equity. So a session with Chris Sullivan from Clifford Chance, talking about the management deal, how that's structured and what that looks like, which can be quite an eye-opener for some people. And then later on that day, a talk from Chris Woodhouse, now at Tilney, but who has worked as a CEO for a number of organizations under private equity ownership and public ownership, and talking about the difference there. Thursday, we look at venture capital, some more early stage, and then some emerging markets discussion in private equity as well, looking at Orios, which is a case based in Africa, with David Easton from CDC and Rob Lucas from CVC, all talking about investing in emerging markets. Friday, really looking into the crystal ball, so really working on some of the research from the Private Equity Institute and looking at what might be coming next. The following week in Oxford, we have a related program, the Oxford Chicago Valuation Program. So this is a program on valuing investments either in private equity or corporate M&A. And it's really a unique program in terms of the number of detailed case studies which it goes into and the number of asset classes which it covers. So you'll see on the slide here, we look at corporate M&A, LBO, growth capital, distress, infrastructure, and real estate. And each of these asset classes we will look at with a case study which is presented by a partner from one of the investment banks or private equity funds that was involved in that deal, talking about how it was structured, why it was structured in that way. So we'll have guest speakers from companies including Rothschilds, Goldman Sachs, Bridgepoint, Madison Dearborn, Patron Capital, and others. So we hope that is of interest, and very happy to send you further details of that. So really just to wrap up and say thank you for your time today. Thank you for joining us. We hope that you will be able to join us either on our next webinar coming up in a month or so, or in June in Oxford. Thank you very much. Bye-bye.